Performance management. Let's start with an exercise. Please comment on performance based on the figures presented for the 2 years. As enterprise manager, could you base any decision on these figures? How about now? Although a breakdown of expenses is available, this doesn't provide much information as compared to the first table. Variations show the enterprise managed an increase in turnover of 50%, but the expenses rose out of control at 514%. Out of all expense, labor costs rose the highest at 900%. But why? We can observe how now that the company has launched a new product in year 2, which is partially responsible for the decrease in performance. The new product generates 100,000 in revenue, but takes 448 to produce. It might also be partially responsible for the increase in utility and maintenance costs. It appears that the enterprise started a new product line that is currently making losses. However, we would be wrong to stop with the performance analysis here. It appears that product 1 also underperformed in year 2. Its gross profit margin decreased by 7%. Raw material costs rose by 37%, by 12% more than revenues, which might be a sign of operational inefficiencies, increases in prices of raw materials, or changes in the bill of material. An alarming increase of 160% in labor costs should make management wonder whether labor efficiency has decreased. It might also be possible that the structure of staff changed, hence requiring an update in the payroll grid. However, some business driver change is reflected by this important variation. What would you do with regards to the underperformance of product 1? Do you consider it alarming? What steps would you take to prevent a continued decrease in performance? The most important thing is to determine the exact cause of profitability decrease. In earlier slides, we presented several assumptions. For example, you would need to know if the 37% increase in raw material cost is due to price increase of raw material or usage of more material, losses, damaged products, or change in bill of material. In order to have this information, separate evidence of raw material unit prices and quantities used for both product 1 and product 2 is needed. No lesser importance is to be attributed to labor cost variations. Are these due to increases in fixed salary, overtime, or bonuses? In order to have this information, separate evidence regarding labor costs per hour and hour needed to make the product for both product 1 and product 2. Based on the performance analysis presented, would you discontinue product 2? If so, why? The correct answer is, it depends. It happens often that newly launched product generates losses for a period of time. This might happen because the target public gets a while to acknowledge and try the product. Most products take more than a year to reach break-even point. However, raw material costs are larger than revenue, which means that the enterprise is not even making a gross profit. It appears that the company is charging a price too small and cannot even cover the variable costs yet. Last but not least, the indirect costs, which in this case are utilities and maintenance, should be allocated to products. Every category of costs needs to be analyzed separately to determine what is the driver for that cost and establish a rule for allocation of indirect costs to products. Very important, the cost center approach. Keeping detailed records of the revenue and expense generated by the product of the portfolio line is typically referred to as cost center thinking. There might be other cost center records relevant for the enterprise, as well, such as cost and revenue per distribution channel, cost and revenue per employee or department. Let's practice together the same exercise with a social enterprise functioning under the umbrella of an NGO. What are your observations? Let's try it together. We can observe that non-profit activity result increases between year 1 and year 2. This is not unusual, as often NGOs cash in installments on payment schedules that differ from calendar years. Hence, at cutoff point, there are high chances that there are money unspent in the bank, which is due to be spent in the next calendar year. Overall, the enterprise seems to become more sustainable over the year. Commercial activity profit margin increases progressively through the years, displaying increased operational efficiency. But beware of potential hidden costs of the business under the non-profit activities expense. Commercial revenue increases significantly, and it becomes the main stream of revenue for the organization, reaching 80% of total revenues in year 3.